under the rug. It's Monday, 15th of January, 2024. And today we're going to be talking about the escalation in global war and the effect this can have on everyday Aussies. We've seen a major uptick in escalation of military events happening on the Red Sea. And this is a continuation of what's been happening in the Israel-Gaza conflict, which happened kicked off back in October of last year, 2023. We've been seeing a lot of events happening with commercial vessels going through that ocean. And this is by the Houthis, the Iranian-backed Houthis, which have been targeting Israeli vessels. And the attempt here is to try to get some kind of an outcome to that Gaza conflict. Obviously, they want Israeli to stop their occupation. But in the last few days, we've also seen a vessel being captured by the Iranian Navy off the Oman coast. So we've had military-style uniform Iranian military-style guys coming onto the vessel and redirecting that vessel back to Iranian waters. And according to Tehran, this is in retaliation for the theft of oil by the United States. So the United States back in September, as we can see here, they seized an Iranian oil tanker, which was on its way to Turkey, carrying more than 980,000 barrels of oil. It was sanctioned by the United States. So this is all tick for tack, but it essentially is a massive escalation of this Middle Eastern conflict, because it's starting to involve Iran, which is a significant power unto its own. Now, the reason why this is so significant is, if you think about the oil that's coming through this Strait of Hormuz, something in the event of 20% of the total daily world's oil consumption goes through this part of the world. So if you are going to see a disruption and more events happening in this area on the sea, then obviously this is going to have a potentially significant impact on the price of crude oil. And essentially what's happening is Iran is sending out these relatively cheap drones, $20,000 a pop, to disrupt some of those vessels that I mentioned. And the United States is responding by shooting $1 million plus rockets at these relatively cheap drones. So, there's no incentive for the Houthis there with Iranian money to continue this continued disruption of this commercial vessels going through the Red Sea. And you can see what's happening here is that a lot of these commercial commercial vessels are going through below the Cape of Good Hope and around Africa to get into Europe, which is delaying travel times by up to 2 weeks. It's increasing insurance costs, and it's increasing the price of energy. So if this continues, we're going to start to see a lot of this passed on to the end consumer, the rising cost of transport here. But more significantly and more concerning here is that it is starting to involve other countries. And what we saw as a result of this Iranian tanker this Greek tanker, my apologies, being diverted back into Iranian waters, we saw the US and British conduct significant military strikes in Yemen against Iranian-backed Houthis there. So you can see that the US and British militaries, they bombed more than a dozen sites used by the Iranian-backed Houthis in Yemen. And that was on Thursday. And that's, again, a massive retaliatory strike using warships, submarine-launched Tomahawk missiles, and fighter jets, according to US officials. And the US Air Force's Mid-East Command said it struck over 60 targets at 16 sites in Yemen, including command and control nodes, munition depots, launching systems, production facilities, and air defense radar systems. So it was 2 nights in a row, both Friday and Saturday night. And according to what we're seeing here, if you have a look at some of the images coming out of Yemen, there are literally hundreds of thousands, if not millions of people in the streets who are all demonstrating this retaliatory impact, these retaliatory efforts of the United States and British forces. So this is not de-escalating at all. If anything, it's ramping up. And the impact of this, as I mentioned, with respect to crude oil, is such that we've seen crude oil be in a downtrend really since October of last year. And that has resulted in inflation as measured by the consumer price data coming down quite significantly. But with this most recent escalation in this military in Yemen, what we could see now is oil prices start to track up quite quickly again. And that's obviously going to translate to higher fuel prices, but not only fuel prices, oil is used in petrochemicals, in pretty much all plastics. So we're going to see higher prices just for consumer products that we take for granted. So the other areas of conflict that are continuing right now, we've still got the Ukraine-Russia situation, but we're also seeing the China and Taiwan situation also escalate. We've just had elections in Taiwan where we've had a pro-Taiwan separatist being elected, and China is not happy about this outcome. So there is a lot of speculation that China may use this situation now with the United States being distracted in both the Ukraine and in the Middle East to possibly invade Taiwan. And if that does happen, then you're going to see an explosion in prices in crude oil. And there's a lot of similarities to what's happening today to actually what happened in the 1970s, which was known as a period of stagflation. So stagflation being stagnant economic growth coupled with rising cost of living pressure. And if you have a look at what happened in the 1970s, we had a situation where we had three major waves of inflation. So if you look at the green line here, that's the consumer price index in the United States. And the blue line being interest rates. And you can see they tracked each other pretty closely. So in the late 1960s, we had a period where we had the Vietnam War raging. We also had the end of the US gold standard. So President Nixon took the US dollar off the gold standard, and that basically allowed the central bank and the Treasury to create as much currency as it needed to fund those wars at that time, the spending that they required. And in 1974, we had the outbreak of the Yom Kippur War, where Syria, I believe, and Egypt attacked Israel, and there was a significant conflict. And as a result of that, you had oil embargoes across the United States. So a lot of those Arab oil exporting countries stopped sending oil over to the US, and that resulted in a significant price increase in crude oil. So you had the massive increase in that one day. I believe it tripled. But if you look over the entire decade of the 1970s, the oil price went up 10 times, or about 1,079%. And as a result of those significant oil price increases, you had a significant recession between 1970 to 1980, which also resulted in significant cost of living pressure. And as a result of that higher inflation, so you can see there were three big waves of inflation in the 1970s. Central banks responded by raising interest rates until they peaked in 1980 at close to 15 or 16% on the 10-year bond yield. So there's a lot of similarities again. If you look at the timing of that Yom Kippur War in 1974, it was 50 years to the day that we've had this most recent conflict in Israel. And as far as the outlook going forward, it makes it a lot harder for, especially now with this most recent conflict and this escalation, for central banks now to start cutting interest rates, which is what the market's expecting. So the US Fed Reserve Governor Jerome Powell in December was talking about interest rates being cut, possibly, and the market's pricing in as early as March or April this year. If we do see a significant increase in the oil price as a result of this most recent events, through Iran and the United States, then there is a possibility that, if anything, interest rates may have to be increased again, like we saw in the 1970s. Now, the difference this time around is that central banks are not going to be able to raise interest rates like they did in the 1970s, largely because of the levels of debt that we have today relative to what they were back in the 1970s. So, for example, if you look at the debt to GDP in the United States today, it's around 125 odd percent. So that's the debt to GDP there, compared to the 1970s, where it was under 40% for most of that decade. So if we were to see an inflation breakout, and again, this is where we are today. So the market, like it was in the early 1970s, was expecting that inflation and interest rates to come back down to normal levels. Everything's going to go back to normal. But then we had that next major wave of inflation, and inflation, they say it's like a genie. Once it comes out of the bottle, it's very difficult to get back in. Now, again, the only reason why the central banks were able to contain inflation in the 1970s was because they were able to get the interest rates up so high. If these central banks today were to get interest rates up anywhere near the levels of the 1970s, they would create a significant global depression around the world. Because if you have a look at the level of debt, as I mentioned in the last meeting, we've got $34 trillion of debt now in the United States. It just ticked up to that level, I believe, in the last couple of weeks. But the debt levels are becoming exponential. It's forecast that the next $1 trillion of debt is only going to take 4 to 5 months to achieve. And again, if you look at the interest on that debt, it's already over $1 trillion. Now, the government in the United States is having to finance all of these expenses, these wars, the interest on its debt, the healthcare system, all through deficit spending, which is basically printing currency. And that is devaluing the US dollar significantly, as we talked about in the de-dollarization that's happening right now. So as a result of the central banks not being able to raise interest rates, and they may very well do so, if they do that, they will create a 1930s style depression. My feeling is that they won't take that road. They're going to go down the road of inflation or potentially hyperinflation, because the priority of the central bank really is to save the financial system. The central banks are owned by the banks, the privately held banks. So if they go down the road of cutting interest rates, what that is going to signal to the market is that the central banks have lost the fight against inflation. And that makes for a much worse situation than actually what happened in the 1970s. Under that situation where the central banks wave the white flag and they give up the fight on inflation, once the market becomes aware of this outcome, then what you potentially are going to see is a collapse in the bond markets, because the question is, why would countries hold US government debt when they are essentially debasing the value of the US dollar at a rate that we've never seen before in history? And this is, again, what we talked about, is if you do have a bond market implosion, then that would be very negative for the US dollar, very positive for hard commodities. But it also means that interest rates in the bond markets, as far as those yields on government bonds, will go up irrespective of what the central banks do anyway. So again, this is all speculation. We don't know exactly how this is all going to play out. But the escalation in the Middle East is what I believe is going to create a lot more cost of living pressure for everyday Aussies. So how are we going to be impacted? We're looking at continued cost of living pressure, higher for longer mortgage rates. So again, what happens in the bond markets in the United States has a very big impact in Australian mortgages, because the Australian banks, as I understand, they borrow close to 40% of all that money that are used to fund mortgages in Australia from overseas markets. And if those bond yields are tracking higher overseas, those costs are going to be passed on to mortgage holders locally. And if we do have rising oil prices, like we saw in the 1970s, then it's very likely that we're going to see global recessions play out. And as we see a global recession, that naturally relates to rising unemployment. So you're going to have job losses, but you're also going to see rising defaults on mortgages. And what we're seeing at the moment, if you have a look at some of the data coming out, so according to Equifax, we're actually seeing a significant increase in mortgage accounts that are in arrears now between 30 to 90 days. So it's almost 50% higher than where it was this time last year. So everyday Australians are already feeling the pinch of the cost of living pressure. A lot of people are on the brink of, having to potentially sell their properties because of the cost of living pressure and the rising interest rates. And, one of the canary in the coal mines is also what's happening with credit card transactions. We're seeing credit cards being used on a scale that we haven't seen. If you have a look, we had the significant downturn in COVID. A lot of that, I believe, had to do with all of the government stimulus money, which is now running out. So you see a massive uptick since COVID back in 2020, since those stimulus checks were written up. The reason why people are going to credit cards is because they're struggling to meet their everyday expenses. So all of this it's quite concerning, but the other impact that we're seeing is in the stock market. So if you have a look at the S&P 500 index, again, we saw a significant increase in the stock market really just in the last couple of months. And that's on the basis that the central banks were going to start cutting interest rates possibly as early as March or April this year. And the stock market is addicted to stimulus. It needs that central bank monetary hit in order to continue to go higher. So the stock market has almost detached itself from economic fundamentals. And if we see a situation where oil prices start to track a lot higher again because of this conflict in the Middle East, and you start to see those consumer price index track higher again also, what it does, it starts to put a wet blanket on those interest rate cut expectations. So it could be a situation where the stock market's getting ahead of itself, and there is a potential for a double top here in the stock market. It's a situation where the stock market reaches one level of resistance, and if it doesn't break through that level of resistance of around that 47.83 on the S&P 500 index, which is the US large cap index, it's an index for the 500 biggest companies there by market weight, then you potentially see a big, drawdown again in the stock market like we saw back in 2022. So again, all of this is speculation. It's not advice. But the impact here is also, if you look at the Australian stock market, we've also got a situation where the ASX 200, it's been struggling to get through that 7,500 level, really going back to sort of around mid-2021. So there's been a number of attempts to try to get through that 7,500 level, and they've failed a number of times. And if we see it fail again, it's likely that the stock market will get back into the trading range, somewhere around 6,500 in the short term anyway. So what's the impact there? There's a potential impact on superannuation balances as well. So I guess one of the question is, what can we do to prepare? One of the things we can do is we can pay off debt. So especially higher interest rate debt first, credit cards, personal loans. Because if we are going to see higher for longer interest rates as a result of continued high inflation, then paying off debt is a good way to help your cash flow situation out. We can also have an emergency buffer saved. You want to have at least 3 to 6 months worth of expenses put aside in the worst case scenario where you lose your job. Look, education is critical as well. So there's a saying which is, if you can't see the freight train coming, you can't get out of the way of what's coming. So part of the reason why we're doing these videos is to try to educate it and let people see what's actually happening in the real world, because commercial and mainstream financial media is not going to present the arguments in this way. And the other thing to consider is you want to try to invest in real assets, such as land, gold and silver, and a lot of people are also going now into crypto, obviously, as well, as a way to diversify out of the US dollar. Now, again, this is not advice, but if you have a look at what happened in that 1970s again, so the stock market and and some of the real assets performed very well. The stock markets actually were quite weak through that entire 1970s decade, because this is the effect of rising interest rates. It does impact on company earnings. So if you look at that S&P 500 over that 10-year period, after inflation, it was well down from the beginning of the 1970s to the beginning of 1980. Whereas if you have a look at the performance of gold through that period, it absolutely soared. It went up about 25 times its value between 1970 to 1980. So stagflation it's the best of both worlds for hard commodities. When you're in an environment where there's a distrust in the US dollar, where the global bond markets are being sold down, people are going to go to hard assets. And that's what happened in the 1970s. There was a distrust in the US dollar and in the bond markets. And I believe this time around, we're going to see a lot of money coming into this space, because as these bond markets are being sold down, the proceeds are going into gold. If you look at the amount of gold that was just purchased by central banks around the world in the last 2 years, it was the most on record. And I believe 2024 is going to be another record. So again, not allowed to advise in this space. It's not advice, it's just a consideration, but we are going to have a very interesting 2024 in terms of how these markets play out. So just finishing up here, it's important to keep an eye on what's happening in the Middle East. Nobody wants war, but there's a saying, and this is by Gerald Salenti, who's a trend forecaster, and he says, when all else fails, they take you to war. The US government is bankrupt, and the level of debt and deficit spending is going vertical, and the amount of money printing is also going vertical. Mathematically, they've got no choice but to continue along this hyperinflation of the US dollar. So all of this is concerning, but there are ways to protect yourself, as I mentioned. And obviously, it's very important to have family and friends to support. And let's see what happens going forward. Thank you for listening today. And if you can subscribe and help the channel, that'd be great. And I look forward to speaking with you soon. Take care. Bye.